Welcome to this session on comparing default probabilities. When we analyze credit risk, we look at two distinct sources of data: historical default rates and market credit spreads. To understand the gap between these two, we first calculate the average 7-year hazard rate using two different methods. In our first method, we use historical data. For a BBB-rated issuer, we see a cumulative 7-year default rate of 2.27%. By applying the natural log formula, specifically -1/7 times the natural log of 1 minus the default rate, we arrive at an average hazard rate of 0.328%. In our second method, we look at what the market is telling us through credit spreads. If we take that same BBB-rated issuer and use a 7-year credit spread along with a 40% recovery rate assumption, the calculation changes. We divide the spread of 0.012753 by 1 minus the recovery rate, which gives us an average hazard rate of 2.126%. When we compare these results across all rating classes, from AAA down to C, a clear pattern emerges. Hazard rates computed from credit spreads are significantly higher than those computed from historical data. This difference, or excess return, represents the compensation investors receive for bearing credit risk. As credit quality worsens, this gap grows even larger. There are several key reasons for this disparity. First, bond defaults are not independent. They are often tied to systematic economic conditions. Because this risk is non-diversifiable, the market requires a risk premium. Additionally, it is often impractical to fully diversify the unsystematic risk in a bond portfolio compared to an equity portfolio. Finally, corporate bonds are less liquid than government securities, meaning the credit spread must also include a liquidity premium. This brings us to the fundamental difference between real-world and risk-neutral default probabilities. Under risk neutrality, we assume the risk-free rate is the expected growth rate of a firm's assets. However, in the real world, the expected growth rate is the risk-free rate plus a market risk premium. Because of this higher valuation in the real world, the calculated real-world default probability will always be lower than the risk-neutral default probability. To wrap up, choosing which probability to use depends entirely on your objective. If you are focused on valuation and pricing, risk-neutral estimates derived from credit spreads are the standard because no additional premium is required for bearing risk. However, if you are performing scenario analysis or stress testing, real-world estimates from historical data are much more appropriate.